we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy treasury bills to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see.
In periods of complacency, the world's central banks play at being the Federal Reserve without having the world's reserve currency or the legal security and financial balance of the United States. Many massively increase the money supply without paying attention to the global and local demand for their currency, and in addition, governments issue more United States dollar-denominated debt, hoping low rates will make the financing of huge deficits affordable. All this, in turn, leads the global demand for United States dollars to increase, not because the Federal Reserve conducts a restrictive policy, but because the comparison with others shows the alternative fiat currencies are much worse. The Federal Reserve System creates dollars. They do this by buying United States Treasury securities and other assets from bank dealers and large institutional investors. When the Fed buys securities, they take delivery from the banks and pay for the securities with dollars that come from thin air. The same system works in reverse. When the Fed wants to reduce the money supply, they sell securities to banks for dollars, and those dollars simply disappear. According to Rickards, a Wall Street insider with more than 30 years of experience as a financial advisor and investment banker, the rise in the dollar poses challenges for the global economy, but those challenges should not be overstated. A narrow focus on the strong dollar underplays what are undoubtedly the more salient forces pushing the world economy toward recession: elevated energy and food costs, energy shortages, especially in Europe, resulting from Russia's invasion of Ukraine, soaring inflation rates prompting central banks around the world to tighten monetary policy, China's growth-strangling zero-COVID policy, and economic scarring and debt buildups left as the legacy of the COVID-19 pandemic. As the Federal Reserve continues to raise interest rates to suppress economic activity, effectively cooling system-wide demand and placing less upward pressure on prices, higher interest rate investments become attractive to foreign investors. This means that demand for United States currency is increased, putting more upward pressure on the dollar. We will now get into the video and listen to Jim Rickards explains the secret behind the Fed's money printing and the global effect of a strong dollar.
People say, well, gee, the Fed, at the height of the pandemic panic, going back to 2020, the Fed's balance sheet was up to about $9 trillion. I had to get used to saying trillion instead of billion, but about $9 trillion. And it's come down a little bit since then. But people say, well, wait a second. How can there be a dollar shortage or a liquidity crisis when the Fed printed $9 trillion? Well, the answer is you have to understand how the money system works and where real money creation comes from, and it does not come from the Fed. And here's why. The Fed did print the money. That's real. But the way they do it, the Fed buys bonds and treasury notes from the primary dealers, from the big banks. And they call up and offer me a 10-year note. Okay, here's the price, done. Goldman Sachs will send the 10-year note to the Fed, and the Fed pays for it with money that comes out of thin air. So that is money printing. It's as simple as that. But then Goldman Sachs, in my example, takes the money and gives it back to the Fed, because the Fed's a bank. They deposit it at the Fed in the form of what they call excess reserves, and the Fed pays interest on excess reserves, so the Goldman's actually making money off it. The point is the money didn't go anywhere. The Fed did create it out of thin air, that much is true, but the recipient who sold the bonds gives it back to the Fed. It sits on the Fed's balance sheet. So the asset side, you've got all these treasury notes, but the liability side, you've got all these deposits, and it just sits there and it doesn't do anything. So where does the real money that powers the economy, if there is, if it does at all, where does that come from? It comes from the banks, because the banks can do the same thing. When the bank makes you a loan, what do? You're a business, you set up a checking account. They say, okay, here's $1 million loan. They put the $1 million in your checking account. Where'd that money come from? They just said you got the money, right? And so they have an asset, which is a loan from you with note, and they got a liability, which is your deposit. So banks create money kind of the same way the Fed does, except it's supposed to be in private commerce. And that money actually can go somewhere. If you're a business, you got to payroll, you got to buy stuff or invest stuff, et cetera. But there's not much of that going on. Velocity is very low. The turnover of money is low. The M1, M2, those are different forms of money. I love the fact that the Fed has M0, M1, M2. It shows they don't even know what money is because they got 3 different flavors. But the point is that hasn't really been going anywhere. Now, but here's the key. $9 trillion on the balance sheet, maybe, 5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion. Quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support 1,000 trillion dollars worth of derivatives. And how does that work? Well, the answer is mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards. And, we don't have to go down the whole litany of names with either each other because they're trading firms or with hedge funds who want them for speculation or hedging or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the $1 trillion institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. It makes no sense, except unless you think something bad is going to happen. If you think we're going to go into a really bad recession in a couple of months, which is what I was just talking about, then that yield on the 10-year note is going to look really good. You're going to have huge capital gains when that actually collapses. The Fed can't control the very short end of the yield curve. They cannot control 5-year notes, 10-year notes, let alone 30-year bonds. So the Treasury yield curve is telling you, it's like right there in your face. It's telling you that something bad is going to happen. Otherwise, those long maturity yields would not be lower unless you think something bad is going to happen. A lot of people don't understand that interest rates peak after the recession begins. It's a lagging indicator because as you go into the recession, people are like, hey, I don't want to lay people off. My revenues are going down. I'll borrow the money. It'll be fine. And then that causes interest rates to go up. But then when it really hits you, just slams you, you're like, okay, I got to fire everybody, and you're lucky you don't go out of business and you default on the loan. So interest rates are a lagging indicator. Unemployment is a lagging indicator because people, they really don't want to lay people off. They will if they have to, but that's like the last thing you do after you've cut out a lot of other stuff. So people look at unemployment's low and interest rates are high, everything's good. No, these are the things that turn around after the recession.
In 2020, the Fed went through the motions of cutting rates, buying assets, and flooding the zone with new money, but it had little impact. The new money went to the banks that gave it back to the Fed in the form of excess reserves. The money never made it to the real economy. Output levels of December 20th, 19 were not recovered until June 2021. Employment levels of 2019 still have not been recovered. Instead of stimulus and robust growth, the Fed gave us more of the same: slow growth, low labor force participation, and stagnant wages. After the pandemic interruption, the economy is returning to the same below-trend weak growth of 2009 to 2019. The Fed didn't rescue anyone. We're back in the long depression that began in 2007.
And this is real. This is way behind the curtain, Ken. This is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which, by the way, is a headwind for gold, the euro's down, sterling's down, the Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. Okay, so first of all, you got a mad scramble for dollars. Why? To buy treasury bills. Why? Because they're the only collateral to prop up everything I just described. Now, but there's evidence of this. And again, you have to know where to look. So right now, the Fed has what they call the reverse repo program. What is that? Well, any bank, any major institution that wants treasury bills can call the Fed and say, give me some treasury bills. And you give the Fed cash It can be overnight or a couple of days or whatever. The Fed pays you interest, so you're making a little money. Then they send you the treasury bills. Well, why isn't that the solution? Why doesn't that work? Well, the answer is you can do that and you can get those treasury bills, but you cannot rehypothecate them. You cannot pledge them to anybody else. You have to keep them. And the Fed might want to unwind that at any time. Well, that's not good enough, because if I'm supporting some other transaction with somebody else and they're supporting another transaction through a chain of, could be 25 banks all in the same, back to back, I want treasury bills that I can pledge to Credit Suisse, so they can pledge to Barclays, so they can pledge to JP Morgan, et cetera. So I got to get treasury bills either at auction from the Treasury, and they're not issuing that many because actually the budget deficit is coming down a little bit, or buy them in the secondary market.
On the political front, the Democrats strengthened their razor-thin majority in the Senate after a narrow win for incumbent Raphael Warnock in Georgia over Donald Trump-backed former football star Herschel Walker. I think the dollar's primary catalyst will remain what the Fed does, as Congress seems like it will still be divided after the 2024 presidential elections unless the Republicans somehow get their act together and have a very strong red wave, but that doesn't seem like the way things are going to play out, said Edward Moya, a senior market analyst at Oanda. What do you think about Jim Rickards' viewpoint? Let us know in the comment section below. Ensure to hit the like button, subscribe, and turn on notifications. Thanks for watching.